Hello, my name is Andrew Barry, and I'm going to be providing an overview of my personal finance package. Um, let's see. For starters, two main things to keep in mind. Number one is this system is designed for simplicity, meaning it's very simple to use. My goal was to develop a system that did not require record keeping on the back end to organize and structure the budget. The way you budget in this system is not based necessarily on your historical expenses. If you want to use historical expenses for your budget categories and amounts, that's totally fine. You can still use the system. But record keeping is time consuming, and time is very valuable, and I wanted to develop something that was very efficient and quick to use. So the first time you set it up, it'll take a little bit of time. After that, it's fairly straightforward, and so that's one thing to keep in mind. It doesn't require record keeping. Feel free to do the record keeping for your own sake. I do that myself, and I enjoy having those additional details. You might refer to your previous expenses for the past couple months to get an idea of your budget categories, and if you want to refer to those for an initial amount for the category, totally fine. That's completely fine, but it's not necessary. The way the budget works is you budget based on your financial priorities, and I think that makes a lot more sense than what you actually spent, because you may not be spending money where you want to be spending money. So we'll get into that a little bit more later. I'm going to review numerous aspects of the package, and it is customizable, and you can use whichever tool works for you. See this as a tool, as small tools. Clarify what you want in your personal financial life, and then pull the tools out of this toolkit that work for you. And if you have a tool, or if you see that something could be changed or improved or created, let me know. We'll develop it for you. Basically, I'm just going to show you how to use small tools to help you accomplish your financial goals. And that's what this video is about. And I'll be talking about other things as I go along, as they come to mind. So, talking about goals, the first thing that you do, I'm going to have this in spreadsheet format and Google Sheets. So you'll have options for both. And the first thing you can see down here, basically each tab is a small tool. And I'm starting with the first tool, which is the monthly calculator, which basically tells you, and I've pre-filled things to make it a little bit simpler, that it will take you some time to figure out what your budget categories are, what your financial goals are. If you're married, talk with your spouse and say, hey, what are our financial goals? If you're single, ask yourself the same question. And this first section here is where you're going to list out your financial goals and estimated costs. This is pre-filled. You will pick categories and goals that are related specific to you. One thing to keep in mind is when you do this the first time, your budget categories will be what you can think of at the time, and as you go throughout the following month, you'll realize that, oh, I missed this, missed that. I'm going to add that next time. Take a note, have a little notepad that you carry around, and write down additional budget categories. Budget categories should be fairly broad, but not too broad. You want to know what expense goes with them. So, for example, if you have a budget category called household, you need to know that you buy toilet paper in that, but you don't buy bananas. They need to be specific enough so that they're easy to track, to know. Okay, in household, I buy these types of items. In groceries, I buy these types. And you'll just do that from experience. So feel free to experiment. I mean, for the first 3 months, you're going to be just testing it out and figuring out how to use it and picking your categories. Same with the dollar amounts. You're going to, in the initial run, you're going to enter in dollar amounts that you think might be close. And as you live life, you'll kind of realize, oh, I had too much there or too little here, and it's a month by month budget, so you can adjust each month. So there's a lot of flexibility. Don't hold yourself to it the first month. You'll get frustrated and be like, I'm not succeeding. Keep that in mind. So monthly goals can be, the monthly calculator can be for monthly goals, like if you want to save for that month. But the best it's usually used for, or the way I would use it, is for longer term goals, 4 months plus, something like that. The reason it's first is because it's motivating to give yourself a reason to budget. And if you have goals and you can see results, you will be motivated to budget. So for example, as you can see here, I've got 3 goals. Trip to Beirut, and I've given it a $2,000 cost, and I hope to leave in January if I'm going to go, and I'm going to save for 4 months. That's not quite accurate because I would buy my tickets before that time, but this is an example. I want to buy a new car, and I want to. I'm going to spend $7,500 on my new car. I want to buy it in 5 years because my current car is doing okay, but I want to start saving for the new car when my current car goes kaput. So I give myself 60 months, and I want to buy a house. Estimating 175, and I'm going to save for 10 months at that. What this tells you is it's just very simple calculation, but it shows you, okay, if I'm going to accomplish the goal that I have set out for myself, I need to do this. For my trip to Beirut, I need to save $500 a month. If I'm going to go to Beirut for $2,000 in January, I need to save $500. If I'm going to buy a car in 5 years, and a fairly nice car, $7,500, you won't get a new car, of course, but it won't be bad. It's that mid-range. I need to save $120 a month to accomplish that goal. And if I want to buy a house in 10 years, or pay off a $175,000 mortgage in 10 years, I need to save $1,458.33 a month. And if I do that, I will accomplish that goal. You will accomplish that goal. That's exciting. When you budget and plan and organize, you will accomplish your financial goals. This is, of course, assuming you do make some money. If you don't make any money, then it's hard to accomplish any financial goals. But assuming you have an income that's reasonable, financial goals are reachable. It's exciting. It's motivating. This is why you start with this one. Dream big. Actually, according to Josh Wilson, you should dream small. But in personal finances, you can dream however you want. The point is, plan a little bit. Spend some time figuring out what your financial goals are. You throw out whatever you think is appropriate. I say travel, getting out of debt, giving, buying a house, buying a car. The sky's the limit. Start here, spend some time, motivate yourself, yeah, this is an exciting spot, right? Just right here. So, you've done that. Next, that's your first tool, your goal, planning your financial goals. Next up is the budget. Okay, so this is kind of your dashboard for all things budgeting. This is the foundation of your personal finance after you establish your financial goals. So, it's very straightforward. The thing you do first is, let's say it is September 1st. You take all of your August earnings, paychecks, different, side hustle, whatever you might have. List out all of your income for the previous month. I'm going to be throwing out a few extra details. So for example, I have a Capital One savings account, and I earn interest on that account. I do not budget the interest I earn. It is my house fund. It goes in the house fund. I wouldn't actually, but I do budget dividend income that goes directly to me. You pick that. You could say I'm not going to budget passive income, which would be, well, you could consider rental passive, but dividends and interest. I'll budget other things. That's one thing. The second thing is, if you have a business, I recommend removing, unless you pay yourself a salary or you take distributions. But what I recommend is operating that business aside from your personal bank account. So you should have a separate business bank account. And what you would do is, let's say you have an Airbnb. That's what we have. And what you would do is you would have a separate bank account for your Airbnb activity. And you would run all your income and expenses through that. Now, two things. If your income runs at a profit, you would then pay all your expenses off, and then you would make a transfer, and you would say, okay, I'm going to transfer $100 in August from the Airbnb account to my personal account. And then you would report that $100 as income, and you would budget it. You would not budget the bank balance in the bank account. You'd leave it in there to cover for expenses, and as you had sufficient funds, you would budget it. You would transfer it over to your operating account and treat it as income. That's how you do a net income operation. If you lose money, you need to budget that. The reason is your business is not financing itself through earnings, so you're going to have to put money into it. And you need to budget that because that's coming from somewhere. Again, I'm going to have kind of side thoughts as they come to mind. When it comes to debt, if you have a credit card and you stay within your budget, that's okay for the most part. There are a couple issues with credit cards. I'm not going to get into those. The debate, there's positives on both sides and there's negatives on both sides. I'm not going to debate that here. Feel free to shoot me an email and I'll provide you with both sides. The thing is, though, if you allow yourself to use a credit card outside of the budget, it basically eliminates or makes budgeting very hard. Budgeting is easier when you have limited money, because if I have $10,000, I can budget that. But if I have $10,000 plus a credit card with, let's just for this example, an unlimited line of credit, I have unlimited money, and there's no the budgeting becomes less meaningful because I have unlimited money. In my mindset is I have unlimited money. So I would like to encourage you, if you use a credit card, make sure that you stay within your budget and don't see it as I have unlimited money. I'm going to give you my quick opinion is you should not use debt in your personal life. So for example, you should not use, and there's one exception, but you should not use debt for buying a car, going to school. There's an exception there, but I'm not going to get into it. That's not the exception I was talking about. Groceries, those types of things. You should not be running a deficit in that area. The mortgage for the primary residence, I think, is the one exception for personal debt. Debt on the investment side, different story. Not going to discuss it. I think there are times where that's okay. I think there's opportunities out there that might be worth going into debt for. But for the sake of budgeting, don't run a deficit because it will discourage you potentially from budgeting because, I've got that extra money, I don't have to be as strict. Your goal is to have fixed income, as in, I know I have this much to work with. If you have a business, again, it can still be fixed because you just take out a certain amount each month. Even though your income and expenses may vary per month, try to find that amount that you can live on and that the business can cover for you. We can talk if you want to. We can talk about that more. Shoot me an email. If your business is operating at a loss, money has to come from somewhere. You might be pulling on a credit line, which I would discourage. So it has to come from your operating account, which means it has to be budgeted. So if you operate your business with a net income, then you pull money monthly if you want to, and treat that as your income for the month. If it operates as a loss, you have got to transfer money from your operating account to your business to cover expenses. And I would tell you, you probably should do a whole business budget, but I'm not going to get into that right now. That's a different picture, different scenario. So you budget for business expenses. Okay? That's if you're working a W-2 job, you're an employee, only source of income, it's very easy. Paycheck number 1, paycheck number 2. Your income's done. I've got 3 in here just for this example, but that could be your self-employment income, and you could just say you could retitle that other income, something like that. So that's where you start. List out your income for the month. If you're married, list out both incomes. Total income should be on here. Total income for the previous month. So you base your budget on your previous month's income for your current month's expenses. So for example, let's say you had no expenses in August and you made $2,000, and your bank account was $0 at the beginning of August and $2,000 at the end of August. You would have only $2,000 to budget. That's how you have to see the zero-based budget. Income minus expenses equals 0. Now a lot of people have a cushion, which I recommend. So again, especially when you're starting out, you're going to go over budget potentially. You don't want to have a zero-based bank account because you'll overdraft, and no one wants to do that. So enter your income in. Now here's the budgeting overview expenses section. And in this section, you're going to list out your budget categories, and this can take some time. Think through it. Think through your expenses. Maybe look at some history. Come up with your budget categories. You can see these here. If you want a list of my categories, I'd be happy to share them. Send me an email. There's a lot in here. A lot of different things you can use. Again, the goal is to provide you with tools that work for you. So you pick and choose what you want. I'm going to go through everything. You pick out what you want. So, step 1, list out your budget categories. Once that's done, if you want to, you can provide additional details and tell yourself how you pay for them. So let's say it's cash. Just kind of have a nice little summary there. Next, you go through and enter in your desired dollar amount. You can use historical expenses, or you can just pick something out of the blue. So for example, books. I want to buy 2 books this coming month. Amazon Kindle, they're about $8, so I'm going to do about $15. And you go through and you prioritize your finances based on your goals. So for example, I'm going to hop back over here to the monthly calculator and say, okay, my trip to Beirut is $500. So I'm going to go back over here, travel fund, I need to do $500. Okay? This is currently rent, I'm going to change it to house. I'm going to hop back over here and say, okay, my goal for the house is $1,458.33. So I'm going to go over here and change that. And then I want to buy a new car, so $125. So car expenses, $125. Now, couple things. Car expenses, $125. That's saving for a new car. But you have operating expenses, so I need to make that $175. $125 of that is your savings, $50 is monthly operating. Similar to the house. If you own the house, you're going to have expenses, so you should make that higher. Just using this as an example. Now, as you can see here, these are monthly expenses because it's a monthly based system. So it's 12 months. You can see your annual expenses for that. I'm going to run through a couple categories here. And 2 that stand out are gas and utilities. I see gas and utilities as somewhat special, meaning you pay what you owe for utilities and you fill up when you need to. The goal is to budget a certain amount so that you don't go over. Because if you go over and you're doing that zero-based bank account, you'd overdraft. If you're just doing if you have a cushion, you don't want to go over regardless. So if your utilities average $170, you might do $180 just to cover for it. If gas averages 95, you might do 125 just to cover. So you've budgeted enough to cover for the extra expenses. Again, gas and utilities, they're budgeted, but you fill up and you pay when you need to. So, you've gone through, you've prioritized your finances, you've listed your budget categories, you put in the amounts, if you want to provide the extra details, your frequency. You go down to the bottom here, right here, and it says this should be 0. So as you can see, you're up by $958, which means that means you have gone over budget and you need to adjust your expenses. Your money's stuck. This is what you earned this previous month. That's all you have to spend on. So, this is where the rubber meets the road. This is where your financial priorities, where you force yourself to meet your financial, to stick to your financial priorities. You have to cut your budget by $958. That's hard. So, okay, you start at the top and you cut. And here's a clear example. I want to buy a car in 5 years, and I need to save $125 to do so. That is one of my top financial priorities, which means I'm only going to buy one book this month. Bulk food. I'm not going to buy organic X. I'm going to buy it regular and hope that it and check to see if it's on the Dirty Dozen list. And if it's not, I'm not going to buy organic. Okay, there's my car expenses. I'm going to keep that the same because $125 is saving for the new car, and my car has been a little rickety. I need the $50. Car insurance, that's a fixed expense. Now, with fixed expense, you have two options. Well, one main option. First, you can't change it for this current month. It's $275. It's fixed. You can't not pay your car insurance. So your one option is, well, two, I guess. Pay it, budget it, can't change it. The second option is shop around. Are there cheaper car insurance options? Don't assume that what you're paying now is what you have to pay next month. This month it's stuck. Next month, you may have found a cheaper place, and it's and you save $200. But this year, or this month, it's fixed. Same with your cell phone. Clothing. I just bought a new pair of shoes, so I'm going to wear those an extra month. Or my jeans almost have a hole, but they don't. I'm going to wear them for another month. So I'm going to save on clothing. I'm not going to spend so much on clothing. I love eating out, but that car is important to me. Here's the thing. What's important to you financially? That's the question you have to answer. If eating out is important to you financially, you're going to budget money for eating out. If buying that new car is important, you have to budget for the new car. Because here's the thing. In 5 years, if you haven't saved for the new car, you're not going to buy a new car. So, you have to sacrifice. Budgeting is restrictive. But actually, if you think about it, it's not the budgeting that's restrictive. It's your income. Your income restricts you. Your income restricts what you can do. So, don't blame the budgeting. The budgeting is your friend because it helps you utilize your income and maximize its potential. Budgeting is structure and provides you guidelines and a format to accomplish your financial goals. Budgeting is actually freeing because it says you can spend $65 on bulk food. It sounds restrictive because you only have $65, but it's not the budget that's restricting that. It's your income and what you have decided to spend money on. The budget, don't blame the budget. Blame yourself. But don't blame yourself. Just prioritize your finances in the way you want them to be. If your priority is buying all organic in bulk, it's going to cost you more. And that's your priority. That's fine. But you're going to have to budget for it at the expense of something else because your income is limited. So, that's that. So you're down here at eating out. You like eating out, but you want that car more, so you're going to cut that back. Education. That may be a side class or something else. Well, I'm going to I don't have any specific thing in mind right now. I don't have a class I'm saving up for, so I'm going to cut that back and just accumulate it differently, or less, and I'm going to get into accumulation later. Gas. I travel a lot. I might be able to cut back a little bit, but just to be safe, I'm going to leave that there. Giving. That one is up to you. Pray about it, and you make that decision. Groceries. I'm not going to buy as many groceries. I'm going to cut back on that. Health insurance. That's fixed for the month, so you're kind of stuck. And so what you do is you work your way down until this gets to 0. And as you can see, it's pretty high. I'm not going to do that in this video, but that's what you need to do. Your expenses need to equal your income. And when that gets to 0, that means you've accomplished it. So and when that gets to 0, you can move on. You're done. Once you've confirmed that the figures you have are what you're happy with for that month. So once it's at 0, you've accomplished the main budgeting thing. And again, that'll take a while because you first have to establish your categories, pick your amount, and then work it to 0. Okay? After that, you go to the next tool, which is cash. Cash is pretty straightforward. You do need to pick the categories that you want to have as cash. I recommend these. I put books on here, but I highly recommend eating out and groceries. The spreadsheet automatically pulls the amounts associated with those categories. This basically is your go to the bank, withdraw the money, cheat sheet. I'll do it really simply. Basically, here are your denominations, and you just list here how many you want per budget category. So for books, I want a 5 and 3 1s. For eating out, I want 5 10s. For groceries, I want 4 100s, $100 a week. I do recommend that groceries be withdrawn weekly. So find the weekly amount. So for example, if your monthly is 400 times 12 divided by 52, your weekly is 92. So you'd make that 92. So a 50, or let's just say 9 10s, 2 1s. Personal, 3 10s, and a 5. So what this does is it makes it really easy. Once you've done your denominations, like for example, if you want to have small bills for certain categories, feel free to do that. You allocate your denominations. You make sure these two figures match. That means that your denominations are correct. And then when you go to the bank, you just ask them, I want 17 10s, 2 5s, and 5 1s. Down here, after you've done that, and actually, yeah, you can do that. Then you take these you have your list of all your cash categories. If you're single, you'll probably have an envelope that you carry around. I say envelope, but it's really, I use a blue small accordion thing from Walmart. Works really well. Makes keeping the categories organized and straightforward. So you'd at least have 1 for yourself that you carry around. If you're married, you'd have 2. And I'm going to hop into this now because this brings it up. A house envelope is what I call an accumulation envelope or accordion or system. I'm going to talk about accumulation briefly. Accumulation is, there are two easy ways to accumulate. Accumulation, let me give you an example. Books. No, let's say car insurance. Car insurance doesn't accumulate. You pay $275 per month because that's your car insurance. Now, travel is an accumulation category because you don't spend $500 a month on that expense. You're saving $500 a month for a future purchase or expense. So that's an accumulating category. The two easiest ways to track accumulating categories are 1, if it's a large enough category, over $1,000, you pick the threshold. You have a separate bank account, a savings account that you link. Well, you don't link it, but basically you have an app. Make sure your bank has an app. Make sure your bank's app can list all your bank accounts, and that you can easily transfer from your operating to those bank accounts. Basically, if your bank charges you fees for checking or savings accounts, switch banks. If your bank does not have an app that is very user-friendly and that makes switching between accounts easy, in my opinion, again, my opinion for both, but switch banks. I believe banking should be free, and the app experience should be seamless. If you need questions on which banks, you could talk to the people that use the bank, the app, or ask the bank itself. So, travel fund most likely will be an accumulation bank account. So you have your operating account and your travel bank account. And every month, you'll transfer $500 from your operating to your travel. Makes it very easy to track your travel balance. If it's a smaller budget category like books, which comes in at $8, but I may not buy a book that month, I use, back on the cash tab, you have a third or second budgeting cash system, meaning an accordion or or envelope system that stays at the house, because you're not going to walk around with your book fund because you're not going to be buying books when you go out. So that stays at the house and it accumulates smaller categories like books. I put medical in there, education, small things like that accumulate. Categories that aren't going to be most likely spent in 1 month. If it's going to take more than a month to spend it, it should be an accumulation. Those are the two easiest ways to accumulate. So, that's that. So you fill in your so basically this is all of your cash categories. Down here, you assign the category to each envelope. So let's say you have miscellaneous, so you put that here, and then you have your books, you put that here. And that just lets you know that when you're dividing up your budget categories, it's easy to say, okay, this category goes here, this category goes here. It makes it fairly straightforward. Okay, I'm going to talk briefly about Back to Bank. Back to Bank is a system that allows you to purchase items online or with a debit card, purchase items that are associated with a cash budget category. For example, your book fund. You've got $50 in your book fund and you want to buy a book on the Amazon Kindle. Costs you $8. So, you can't pay cash for an Amazon Kindle book. So you go online and you purchase it with your debit card. You've got $8 debited from your main operating account. The way you account for that is you take $8 from your book cash envelope and put it in the Back to Bank envelope. Every month or however often you go to the bank, you take that money and redeposit it to your account. So what happens is your bank is now zero again. It's a wash. You lost 9 or 8. You paid 8 out of your bank account. You deposited 8. So that transaction washes out. So there's no worry there. And your book fund represents a negative, or it's now less by $8. Now, I'm going to talk about cash versus debit card. People say, okay, if I use cash, I'm going to lose it. It's going to get stolen. This, that, and the other. Those are viable considerations. I don't think they're strong enough to deter me from using cash. Here's why. If you use a debit card, let's say you budget $50 for eating out, and you use a debit card to eat out, and you go to a restaurant and you spend $13.85. So now you've got $36.50 or whatever. Okay, I got $36.50 by eating out. You can remember that for a while, a day. You wake up the next day and you're like, I think I had $13.70. I think I had 12. I can't remember how much in my budget in my eating out category. Oh, I just ate out again. Now I've got, I don't know. I don't remember how much I have left. That's the challenge with a debit card. Tracking how much you have remaining in your budget category is extremely hard. Again, this system is designed to be simple because people, if it takes time to budget, people are less likely to do it. Budgeting is usually time consuming. This system is designed to make it very simple. Here's the benefit of cash. I know you might lose it if you're not careful. You might get stolen if you live in the wrong neighborhood, or even the right neighborhood, and it might still get stolen. That's something to consider. Be cautious, pay attention. I think you can avoid both those. Here, you got $50 cash. You got 5 tens. You go to a restaurant, you spend $10. You give $10 to the person. You go home. You think, oh shoot, how much do I have left in eating out? You open up your envelope system. You count your money. You got $40 left. No record keeping. You didn't need to keep the receipt. You didn't need to do anything. You didn't need to scratch your head. It's right there. You got $40 left. No questions. No confusion. No receipt tracking. No expense recording. It's very simple. Using cash is simpler than using a debit card. Quick comment on receipts. The main reason to keep a receipt is if you want to return an item. Because if you're using cash, you don't need a receipt because you don't need to do any expense record keeping. The remaining balance is there, so that it frees up that paperwork. If you were doing a complete picture and you wanted to track your expenses and that sort of thing, then a receipt might be necessary. But if you're not, it simplifies it. Again, the goal was to develop a system that was very simple, and that's what you have here. So, you've allocated your different cash categories to your envelopes virtually in this application here, and your physical envelope system. So that's done. This cash tool makes it very easy to pull out all your cash categories. You get your dollar amount automatically assigned, assign your denominations, withdraw the money from your bank account, and allocate, and then pass out your budget categories. So that's what this one is. Next up is debit card transactions. There are very few debit card transactions. One would be gas. And as you can see, I typed that in and it pre-filled the dollar amount. Gas is debit card because it's simpler. You don't have to walk up to the counter. You can do it. Fill up when you need to. Budgeted amount that usually will come over so that you're not going over your budget. The reason I have it here, it just so you know what your debit card transactions are for the month. You know what should come out as a debit card transaction. Fairly straightforward. Not much here. Just a nice little overview. Check. Same thing with this. Check transactions. It just shows you what you might rent or you might pay as a check. So if you paid rent still by check, you'd put that on here. Or if you paid your car insurance, you'd put that on here if you paid it by check. You might like to have a clear picture of that. Auto withdraw, similar, but you have a date function here where, okay, here are my 5 categories that are auto withdrawn. Here's the amount. So, for example, retirement. It's auto withdrawn, goes directly to your Roth, IRA, 401k, whatever it might be. And the date just gives you an idea. Okay, this comes out on the 15th. So you just kind of have a clear picture of when money is leaving your bank account. I would try to schedule your transactions like this around times when your bank account is higher so that you have sufficient funds. You don't have to worry about that. Bill pay. Another feature I think that should be with all banks. If your bank doesn't have it, you might consider changing banks. Bill pay. Again, it eliminates check writing. It eliminates paperwork. It makes it easy. Your bank should be able to, for free, pay your bills for you, as in schedule them. So, for example, utilities utilities aren't fixed, but I would actually auto withdraw. I would automate as much as possible your transactions. The goal is to have basically cash and auto withdraw or bill pay. Those are your 2 goals. You have as many cash transactions and auto withdraw bill pay as possible. So your paperwork is minimal. So for bill pay, make sure your bank can do it. If it doesn't do it, consider switching banks, as long as the other bank you go to has free banking and a good app. Bill pay is easy. You can easily pay your bills on time, fixed amounts, If it can't be fixed, like with utilities, set it on auto withdrawal. Make sure, if you have a credit card, make sure your credit card's on auto withdrawal so you never miss a payment. So that's the same with bill pay, bank transfers. Basically, this will be your categories, your accumulation categories like travel, your car fund, your house fund, things like that. Are you saving up for a car? Have a car bank account because it's going to get over $1,000 shortly. So transfer that over. List that here. Just gives you a clear picture. So basically, once you're done, basically you budget here, the amount, and once you've set this up, all these amounts, the new amounts for the month will autofill, and you can just sit down, go to your bank, go to your transfer page, make all the transfers. It's all here, very clear, very simple. Okay, emergency fund. This is a very simple tool. It's helpful though. Pick out your bare minimum expenses. So I have gas, groceries, rent, and utilities. If everything falls apart, what are the basic things that I need? I came up with 4. You pick yours. It automatically pulls the amounts. Rent is 0 because I changed that from, I think I need to be house. So it's house. Let's say that's your mortgage payment. So, and I want to have an emergency fund. If I lose my job, I want to be covered for 3 months. So I'll just plug in 3, and that gives you what your emergency fund should be. If you think you can find a job within 3 months after losing it, your emergency fund should be $7,000. If you feel like you might live for 6 months, your emergency fund needs to be $14,000. Again, that's a high figure. It's ideal, but these are your expenses. They're monthly expenses. That's what your emergency fund needs to be on if you're going to live for 6 months without an income. Ideally you have savings, but that's what an emergency fund is for. And that's just a nice, easy calculator. So, debt snowball. Basically, this spend a little bit of time here. If you have any debt, go ahead and provide the description, put in your balance, put in your minimum payment, put in the interest rate. Again, there's a debate here, but I recommend, and I can provide you the both sides of the picture, listing your debts smallest to largest, because debt is a what's the term? It's habit or personality versus math. And to get out of debt, you're going to have to change your habits and your financial perspective. And if you put your biggest debt first, even though it has the highest interest rate, it's going to be a while before you really see any progress. But if you pay off a $500 debt and that's gone, it's exciting. Motivation. You're excited, you want to do the next thing. So you can see here, basically how this works is, my balance is $1,000, minimum payment's $500, and I'm just going to say, let's say 5% interest. So, you pay the minimum payment, okay, and in 2 months it's paid off. You go from 1,000 to 500 to 0. Now, this is what's cool. What happens now is you take your minimum payment on this debt and roll it over here. As you can see, though, this first, let me move this out a little bit. So, let me show it this way. So, as you can see, you have $100. Okay, so your balance is $1,000. You're paying $100 a month. So the first month you go to $900, then you go to $803, and as you can see, it's not $800 because of interest. And then you work yourself down, and you're paying the minimum payment on this. And in 10 months, that's paid off. Okay. Next, you can see here that this debt you're paying the minimum payment on for 10 months. But as you can see, as soon as this one's paid off, you now take this minimum payment plus this to come up with 110. That's the snowball effect. You now have 2 minimum payments going against this debt. And so this debt gets paid off. And then let's say you had another debt. You would take this, you pay minimum payment on it, and then you would take this minimum payment and this minimum payment, and now you have 3 minimum payments. And you work your way down. That's the debt snowball. You pay minimum payments on all your debt except the smallest. And you knock as much as you can out. And so hopping back to your monthly calculator, debt. My debt is $1,000. The one I want to work on this month is $1,000. I want to have it paid off in 10 months. So I need to budget $100 for debt. And that would be this. $100, $100, $100. If I were you, I would budget more to pay off the debt. And I'll show you why shortly. This is the debt snowball. If you have any questions about this, it's a little involved, but fairly straightforward. Let me know if you have questions. So, here's why I recommend that you pay off debt as quickly as possible. I'm going to give an example with a mortgage. I'm just going to use really simple figures. Let's say your mortgage is $150,000. Your interest rate is 3%. Okay? So, it's a 15-year fixed rate mortgage, which is what the financial expert Dave Ramsey recommends. Again, there's differing opinions, but for this example, that's what I'm going to use. It gives you little instructions. Enter loan amount, enter interest rate, enter loan period, enter number of payments to be made, enter the start date, and the amount of extra payments. So that's what that is. As you can see over here, there's your payment. And you can see here, you're going to make 180 payments. You can ignore these figures for now, but what you can see here is over a 15-year period, you're going to pay $36,000 in interest. Okay? $36,000. If you make the scheduled payment on schedule, you're going to pay an additional $36,000. So you pay $150,000 for a house. It's actually going to cost you $186,000. Now, here's why I recommend paying off the debt sooner. If you make the monthly payment of $1,035, and then you say, okay, I'm going to make an extra $100. You're paying your current additional cost is $36,000. If you can budget $100 extra, watch what happens to your total interest cost. It goes down by about $4,000. So by paying an additional $100 per month, you save about $4,000 in interest. 36 minus 32, $4,000. Paying an extra $100 a month will save you $4,000 over 15 years. So do the math. You're saving an extra $266 a year, or per month. You're saving an extra $22 a month in interest. Now, go back over here, and you look at yourself and say, huh, that's my monthly clothing budget almost. I'm going to be able to pay, I can save enough money to pay for my monthly clothing budget by just paying an extra $100 a month on my mortgage. Okay? There you go. That's why I recommend that you pay a little bit extra per month on your debt. Let's say you have a car loan at $20,000. And car loans are usually drastically more expensive. So let's say it's at 7%. And it's a 5-year loan. And you're going to pay $12 per month. So, a $20,000 car actually costs you almost $24,000. You pay an extra $100 a month, and you save a substantial amount of interest. Okay? It's not as much because the loan period's shorter. It's, what, $1,000 maybe, $800? But, percentage-wise, it's substantial. So, again, when you're borrowing money, if you borrow money, plug in the details on this screen, the house mortgage, car loan, student loan, whatever that might be, plug in those details and educate yourself on how much it actually costs, interest-wise, and how much you can save by forcing yourself, by prioritizing paying off your debt sooner. The savings are substantial. I've got a house mortgage calculator, car loan, student loan, credit card. Okay, those things you can manipulate. They're calculators. Play around with them. Get familiar and recognize how much borrowing money actually costs you. Up next is details. Details is basically if you do want to, in a simple way, track your expenses, you can. So, for example, if you wanted to enter your budget categories, total each budget category, you can list those out here, and you can have a little bit of record keeping if you want. That's up to you, not necessary, only if you want to. There's another thing here for goals. It's a little more involved. Basically, set yourself a goal, put in the goal amount, put in your end goal date, 10 years, and then if you were to put that in and your budget amount was a certain amount, let's say it's $1,500, you put that here and it's just a way to see history. And if you look down here, I've developed a little thermometer chart. It just gives you kind of a visual of how you're doing goal-wise. And you can see, okay, you've paid off 17,000, you got 133 to go, and I'm just putting in random figures here. But you can see how the pie chart moves up as you make progress. So it just gives you a visual. Short-term goals, 12 months, or actually less than 18 months probably. And then you have one for long-term goals. Same thing, but a lot more months. And then I have an income and tax tool. Let's say you're self-employed, single, and you make $30,000. It's extremely expensive to be self-employed and single. So self-employment tax is extremely expensive. What this does is this says, okay, and let's say, okay, maybe you make it consistently throughout the month, and you make $1,500 across the board. This says, okay, your average income is $1,500 before tax. Your average tax is $251, so your net income is $1,249. If this is your financial situation, you make $1,500 a month, what you would do is you would do two things. One, for your budgeting purposes, you take this $1,249 and you go back to your budget and you put in $1,249, and that's your income for the month. And you go through and you allocate your expenses to equal 0. Okay? If you're in Excel, these 3 dots navigates you to other tabs. And there's a lot here, that's why I have to do that. So, that's what you would use. The second thing you would do is you would set aside $251 a month to save for taxes. And if your income was substantial, you might do a estimated tax payment and pay in $753 a quarter in estimated tax payments. What this tells you is, okay, this tells you I make $18,000 a year. My income tax liability is $473, not much, but my self-employment tax is substantial. My total tax is that. Okay, pick your filing status, and you're going to see that this is going to change. Actually, it might not, because I think the standard deduction is the same, so it didn't change. But if you were married filing jointly, you would see that would change, can go to 0, because the standard deduction is $24,000, and that's higher than this. So, but your self-employment tax is the same. There's your marginal tax rate. This just shows you taxes and what your budget income amount should be. Fairly helpful if you're self-employed. If you make a certain amount, let's say your income is sporadic, and in March you make $15,000, and in June you make $7,000, or July you make $7,000, and in September you make $20,000. What this does is it just gives you it helps you average your income and say, okay, well, my total income is $42,000. Let's see something. Let's see here. So I want to make sure my formula is right here. It's looking a little high. It's the average of B4 to M4. Let's see. Excuse the technical glitch here. You can't make that much. You can't. Okay, so let's say it's 500. Oh, you know what? Okay, that was the glitch. If I didn't have a figure in there, it was averaging each of these. No, it wasn't accounting for each of these. So you would have to put in 0 to make sure your average is correct. Sorry about that. So as you can see, my income is pretty sporadic. But what this does is that, okay, your annual income is going to be $26,000, but your monthly income on average is $21.67. There's your tax amount, and that's how much you should save for. That's how much you should save for taxes, and that's how much you should enter in your income for your budget. Again, pick your filing status. If you're single, make sure you switch that over. That's going to bring that up a little bit because your standard deduction is lower. So you can mess around with this. This is income and taxes. So those are the cool current tools that I've developed. I'm going to hop back over here because there was a few things I missed. On the budget tab, budget tool, down here there's just some informational stuff. Has your monthly income figure, your monthly expenses, difference. That should be 0. These things you'll see, they're just kind of keys. So if you see orange, auto calculation, this one's emergency fund total. That just kind of carries over your emergency fund. This is kind of your dashboard. This thing here tells basically it totals the amounts you've entered on these different areas, and you need to assign or you need to input each category. Basically, every budget category should be on one of these because you either pay cash, debit card, check, auto withdrawal, bill pay, or bank transfer. So each of those should be assigned there, and this is just your check. It pulls all the totals from the different ones, and just lets you know that okay, you've assigned all of your budget categories to one of these, and this is your check. That's what that is. Kind of a dashboard. This is your main budget dashboard. The other ones are kind of additional tools. So that's the overview of the budget package. Again, ask any questions you have. If your specific situation would benefit from a special tool, let us know. We'd be happy to design it for you. If you have any questions, I will, in the email or the Dropbox, I'll have contact information so you can call me or email me. I'm available. I'd be happy to sit down with you and do a free consultation to get you started, jumpstart you. And I'm going to have this available in Excel and Google Sheets. And if you want, ask questions, and I might throw out little tidbits on our Facebook page or via email. If you're interested in that, like us on Facebook. That says things like why do you use cash, and I'll just answer that question as to why, or how do I accumulate a budget category, or things like that. Just things that you might find helpful. So again, it's customizable. Our goal is to help you accomplish and reach your financial goals, become debt-free, save for that trip, buy a house, buy that car, whatever that might be, give a bunch of money away. You pick. We're here to serve you. Give us a call, shoot us an email, and we're on your team, and we're excited to be able to serve you in this capacity. This video has gone about an hour. I recommend watching the whole thing. It's about how long a session would be. And we're excited you're watching this. Take the time. It's worth it to spend an hour doing your personal finances. And you're going to fill this out the first month. It might take you a couple hours as you kind of think through things. The next month, most of this is filled out. All you've got to do is plug in the previous month's income, and adjust your financial priorities. Some priorities, like your house, are going to be the same that month. But maybe you bought your plane ticket and you don't have any travel plans, and so you're going to zero that out, and you're going to save. You have a lot of friends coming into town, so your eating out is going to be higher, and so you might increase that. So you have underlying long-term financial priorities that shouldn't change month over month, and then you have month-over-month priorities that are going to change. You're going to save for this small thing here, small thing there, this priority, that priority. So I recommend sitting down the first week of each month and going through your financial priorities, making sure they're current and they're what you want them to be, and allocating your expenses according to your income, and getting this to 0. That's one of your biggest financial goals, to ensure that you're not spending more than you make. If you do that, you will succeed financially, and you will pretty much unlimited, based on your income, of course, but your financial goals, you'll be able to accomplish pretty much anything you want with discipline and patience. So, that's it. Thanks.